This voiceover intends to provide a summary of the key findings of the report comparing JD Sports Fashion and Next plc's financial performance over the last 2 years, with particular analysis of JD Sport. Both businesses' annual accounts and data from the London Stock Exchange have been key foundations of the research. Part of the FTSE 100, JD Sports and Next are multinational clothing retailers established in Britain. London Stock Exchange 2020. The report provides information regarding how the business is performing, its financial structure, solvency, capital growth, and the potential investor returns through a ratio analysis of data with inclusion of profitability, liquidity, gearing, and investment ratios. Britain's biggest sportswear retailer, JD Sports Fashion, is owned and managed by Petland Group plc, Johnston 2018. JD Sports is outperforming competitors whilst rapidly growing and expanding. Over the last 5 years, the company's income and profits have increased year on year. JD Sports 2020. The business have expanded overseas and generated more sales due to consumer trends such as the rise in popularity of individuals wearing sportswear for fashion, not just for sport. Morgan 2019. To put this into perspective, the company's total revenue increased by 50% from 2018 to 2019. JD Sports 2020. The company performed well and took a higher level of revenue in all of its geographical locations. A significant amount of this revenue was as a result of expansion to America, where the company took $967.3 million. JD Sports 2020 133. When compared to Next, in 2019, JD Sports revenue shows stronger and faster growth. Next taken present a slower yet steady increase on last year's income. The company saw a drop in in-store sales, but a rise in users online. Next 2020. JD Sports gross profit margin shows a slight reduction of 0.9% from 48.45 in 2018 to 47.55 in 2019. This was as a result of lower margins from Sports Zone and Finish Line. Having said this, both years the company have a gross profit margin above the industry average of 45.6, CSI 2020. Given Next gross profit margin was 34.17 in 2018 and 35.37 in 2019. When compared, JD Sports gross profit margin is over 10% higher, further highlighting that JD Sports are performing effectively. Given that the company opened 83 new stores globally, JD Sports' operating profit margin dropped due to an increase in the cost of sales, staffing, distribution, and administration fees, which caused a higher operating cost. JD Sports Annual Report 2020, page 136. The company's annual report showed the annual cost of sales increased for JD Sports by 51.82%, whereas Next saw a reduction in their cost of sales of 1%. Last year, 87.75% of Next revenue came from the UK, a lot higher than JD Sports, who operate in more areas abroad. Next 2020. The fashion retail high street has been struggling for years, and based on this, Next chose to close multiple stores and focus on their online platform, Wood 2020. Within the report, there are graphs to highlight JD Sports' profit before tax has increased year on year, whereas Next profit before tax has increased annually since 2016. Rapidly expanding into new markets, JD Sports are currently financed by bank borrowings and retained profit. The business's main risk is its current debt, interest, bank loans and overdrafts. Additionally, the company has financial risks in relation to exchange rates, interest rates, credit risk and liquidity. JD Sports 2020, page 155. The profitability ratios show JD Sports have a lower return on investment in 2019 when compared to the year prior. JD Sports return on capital employed was 27.14% in 2018 and 24.91% in 2019, a decrease of 2.23%, whereas Next had a significantly higher return on capital employed of 54.38% in 2018 and 68.49% in 2019, therefore suggesting JD Sports have not used their capital as effectively as Next. The report includes calculations and analysis of liquidity ratios. It saw JD Sports working capital change from 246.83% in 2018 to 174.47% in 2019. Additionally, in 2019, Next had a slightly higher working capital of 182.66%. Given that most retail businesses aim for a working capital of 150%, both businesses' working capital show potential for growth and the ability to pay any debt. Collier, 2015, page 135. JD Sports acid test shows a big decrease of 69.03% in 2019 against 2018. This is due to an increase in current liabilities. Next ratio saw a decrease of 8%, however both companies still have a high ratio, which shows financial security of both companies. Both companies have assets which they can use to cover the current liabilities. In 2018, it took an average of 43 days for JD Sports to receive payment, though in 2019 this number decreased to 35 days, which is slightly below the business average of 36 days, at Trill and McLeany 2019. But in 2019 it took Next significantly longer at over 100 days. This interrupts the business cash flow and causes risk. Black 2005. In 2019, JD Sports held stock for 25 days, longer than the 17 days that they kept stock for in 2018. In comparison, in 2019, Next held stock for longer in their warehouses. The stock day ratio showed the company had stock for 69 days, longer than their previous of 63 days. Given that this is expensive to hold stock for too long, it's a potential risk. Having said this, it can be useful for when stock experiences unexpected busy periods or during times of delayed delivery. Black 2005. Furthermore, when working out the creditor days in 2019, on average JD Sports paid their suppliers quickly within 5 days, whereas Next took considerably longer at 89 days, a notably big difference between the companies. Waiting too long to pay suppliers can cause disputes. Black 2005. Ideal gearing ratios for companies of this scale are between 25 and 50%. This considered optimum. Collier 2015. JD Sports gearing ratio is 32.58% in 2018 and 31.27% in 2019, whereas Next gearing ratio is 27.17% in 2018 and 40.52% in 2019. Based on this, both companies currently sit within the percentage considered optimum, with JD's ratio slightly lower. A highlight of the annual report was JD Sports dividends per share, which has an increase year on year for the last 4 years, London Stock Exchange 2020. In fact, over the last 5 years, investors have received an increase on return, JD Sports 2019 P187. The organisation have identified potential risks such as Brexit. Problems which may occur include a no-deal outcome and port delays. A graph from the London Stock Exchange within the report shows on the 16th of April 2020 the company's share price dropped by 10.26% as a result of their takeover of Footers Island plc. This was as a result of a review to take over which revealed the acquisition may not satisfy rivalry worries. Nakadar 2020. In conclusion, it is evident that JD Sports are rapidly growing and performing well, with increased year-on-year revenue. It's a sign of the business's strength. Risk factors such as online shopping, Brexit and coronavirus are current and future challenges faced by both businesses, which will require forward thinking and adaptability. Based on current issues, it is recommended that the companies invest and focus on their own online platforms. Given that the coronavirus has led to government guidelines which have further led to non-essential stores being closed, the company should pay particular attention to the delivery logistics.